Your Uber app says you made $847 this week. Your bank account disagrees, and Uber is counting on you never doing that math. According to a 2023 analysis by the Economic Policy Institute, Uber and Lyft drivers earn a median of $9.21 per hour after vehicle expenses, taxes, and unpaid waiting time. That is below a living wage in every major United States metro. And the reason why comes down to a single transfer of costs that Uber has spent $224 million in a single state alone to keep invisible. We will get to exactly what that transfer looks like, but first, let's take the temperature of the discourse. Uber says its drivers earn $36 an hour on average. More Americans turning to gig work as inflation bites. Uber posts record profits. Drivers say they can barely afford gas. MIT study says gig drivers earn as little as $3.37 an hour after expenses. Dara Khosrowshahi: our drivers are entrepreneurs, not employees. By Q4 2023, auto loan delinquencies of 90 days or more hit 3%, the highest since 2010, according to the Federal Reserve Bank of New York. Okay, so the signals are contradictory, and they are contradictory on purpose. Let's build the actual framework. The gig economy's foundational promise is simple: own a car, earn money, be your own boss. Uber's 2023 annual report recorded $9.4 billion in adjusted EBITDA. The platform is, by conventional accounting, enormously profitable. But there is a second set of books, and it belongs to the drivers. Under IRS rules and the Federal Fair Labor Standards Act, Uber classifies its approximately 1.5 million United States drivers as independent contractors, not employees. That classification shifts an estimated $3,000 to $6,000 per year in employer-side tax obligations directly onto each driver. FICA payroll taxes, health insurance, vehicle costs, all of it. Uber CEO Dara Khosrowshahi stated in a 2022 Bloomberg interview that Uber drivers earn more than $30 an hour on average. That is a gross figure. It excludes vehicle costs, self-employment taxes, and every benefit a W-2 employee receives automatically. Gross and net are two different numbers. The platform has every incentive to publicize the gross one. Uber's own driver requirements mandate vehicles no older than 15 years in most United States markets. Drivers who do not own a qualifying car must enter the auto financing market before they earn their first fare. The platform creates the demand, the lender captures the value. Now, there are three distinct mechanisms that make this work, and the first is the one we need to name properly. The IRS standard mileage deduction rate in 2024 is 67 cents per mile. This is not an arbitrary number. It is the government's best approximation of true all-in vehicle cost: depreciation, insurance, maintenance, tires, oil, the full invoice. Most rideshare drivers report accumulating 30,000 to 50,000 miles per year on the platform. Run that math: $20,100 to $33,500 in annual vehicle wear, generated quietly, invisibly, with every fare accepted. That bill does not arrive weekly. It arrives at trade-in time, or when the transmission fails, or when the loan rolls over and the car is worth less than what is owed. This is what we call the Vehicle Depreciation Subsidy. You might think it is simply drivers underestimating costs, but it is actually a structural feature of Uber's profit model. Basically, Uber does not own any cars. It has offloaded its entire vehicle fleet onto 1.5 million individual balance sheets. Uber's per-mile payout averages between 59 cents and 72 cents, according to Ridester's 2023 data, and base rates have dropped roughly 40% since 2015. After Uber's 25 to 30% commission cut, the driver's net per mile frequently falls below the IRS cost floor. The car loses resale value whether the driver notices or not. It is a hidden invoice. And the Vehicle Depreciation Subsidy is the mechanism by which Uber's cost structure is perpetually someone else's problem. Consumer Reports estimates that a vehicle used full-time for rideshare accumulates wear equivalent to 3 to 4 years of normal consumer driving every single calendar year. A car financed over 60 months is often mechanically exhausted before the loan is paid off. The driver ends up paying a loan on a car that no longer qualifies for the platform. Please. So, we have established the Vehicle Depreciation Subsidy. But here's the thing. Uber's legal architecture is specifically designed to make sure this cost can never come back to the platform. The second mechanism is the classification firewall. In most states, employees receive mileage reimbursement by law. Independent contractors bear their own vehicle costs. That is not a technicality. That is the entire business model. Former FTC Chair Lena Khan and multiple state attorneys general attempted reclassification of gig workers. California's Assembly Bill 5 would have reclassified drivers as employees statewide. In November 2020, California voters passed Proposition 22, backed by $224 million in spending from Uber, Lyft, DoorDash, and Instacart, the most expensive ballot initiative in California history. The classification firewall held. There are two things to understand about that $224 million figure. First, it tells us exactly how much the contractor model is worth to the platforms. Second, it tells us the Vehicle Depreciation Subsidy is not incidental. As independent contractors under Schedule SE of the United States Tax Code, rideshare drivers pay the full 15.3% FICA self-employment tax on net earnings, double the 7.65% employee share. A driver earning $40,000 gross owes roughly $5,650 more in FICA taxes than a W-2 employee at the same income level. That cost is embedded in every dollar earned and rarely disclosed during onboarding. Uber's valuation at approximately $150 billion in 2024 would not survive a federal employee reclassification ruling. The subsidy is load-bearing. Now, you might be thinking, this is exploitative, but at least drivers can stop whenever they want. We will get to that. The third mechanism is the debt escalator, and this is probably going to get worse before it gets better. In 2023, Americans held $1.6 trillion in outstanding auto loan debt, roughly equal to the entire GDP of Australia. Subprime borrowers, those with credit scores below 620, account for nearly $300 billion of that total. That subprime slice alone would rank as the 45th largest economy on Earth. Uber's Vehicle Solutions program connects prospective drivers with lenders and auto dealers. The effective APR for gig worker profile borrowers runs 14 to 21%, according to Experian's 2023 data. Between 2015 and 2017, Uber operated its own subprime leasing arm called Exchange Leasing, signing up roughly 40,000 drivers at effective rates critics pegged above 30% APR before Uber shut it down at an estimated $525 million loss. Uber exited the leasing business. The predatory lending gap it vacated was immediately filled by third-party subprime dealers. Under rules the Consumer Financial Protection Bureau has repeatedly flagged, auto dealers are legally permitted to mark up the interest rate offered by a wholesale lender, a practice known as dealer reserve, by an average of 1.5 to 2.5 percentage points on subprime contracts. On a $25,000 5-year loan, a 2-point markup costs the borrower roughly $1,400 in additional interest, money that flows to the dealer. A 2022 study by Edmunds found that 44% of trade-in vehicles carried negative equity, with the average underwater amount reaching $5,341, a record at the time. Dealers routinely roll that negative equity into the new loan, resetting the debt clock. As the car depreciates faster under high-mileage gig use, drivers go underwater on the loan within 12 to 18 months. Most standard personal auto insurance policies contain a transportation network company exclusion that voids coverage the moment a driver activates the Uber app, creating a liability gap requiring a separate commercial rider costing $50 to $200 per month. That line item never appears in the gross earnings figure either. Sounds familiar, right? The driver cannot stop driving without defaulting. Uber collects its commission on every fare, regardless of whether the driver is cash flow positive. That is not a coincidence. That is a captive labor supply. So let's run the counterfactual. What happens if the vehicle depreciation subsidy gets priced in? Based on MIT and Zoepf cost modeling, Uber's fares would need to rise 18 to 35% to make drivers economically whole. That increase would likely suppress ride demand, compress growth, and pressure the $150 billion valuation. Even if only half of drivers correctly accounted for the IRS mileage cost, the supply dynamics would shift enough to push base rates up. But neither of those scenarios is what Uber's expansion strategy anticipates. Uber is actively growing its driver base to keep supply high and surge pricing rare. More drivers means lower per-driver earnings. Lower per-driver earnings means more of the subsidy. The CFPB reached a $98 million settlement with Ally Financial in 2013 over discriminatory dealer markup practices, at the time the largest fair lending settlement in United States history. Dealer reserve markups remain legal and widespread. One landmark settlement changed almost nothing structural. According to a 2022 report by the Rideshare Guy, approximately 50% of new Uber and Lyft drivers quit within their first 12 months, citing earnings that failed to cover vehicle and operating costs once they ran the actual numbers. High churn means a constant pipeline of financially naive new entrants to replace those who learned the hard way. Uber's own investor disclosures show the company retained approximately 27 to 30% of gross bookings as platform fees in 2023, up from roughly 20% in 2017. For every $100 a rider pays, the driver receives between $70 and $73 before any vehicle, tax, or insurance costs. The platform's cut has grown by roughly a third in 6 years. The driver's gross slice has shrunk before a single expense is paid. The Vehicle Depreciation Subsidy is not a bug in the system. It is the system. Lina Khan's FTC could not kill it. California voters funded its survival. Every driver who signs up without running the IRS mileage math is unknowingly donating the depreciation. The United States Bureau of Labor Statistics estimated in 2023 that approximately 16 million Americans, roughly 10% of the workforce, work in some form of gig or independent contractor arrangement. That is not a niche story. It is a structural feature of how 1/10 of the American labor market is financed. The Vehicle Depreciation Subsidy is why Uber could be simultaneously unprofitable for years and then suddenly enormously profitable. Someone else was always paying the hidden cost. It just never appeared on Uber's books. Whether that changes is an open question. But the next time someone tells you they are making great money driving for Uber, you know what to ask first. Run the IRS math. 67 cents per mile times every mile they drove. Then subtract it from the number the app showed them.